Welcome to the Real Talk Real Estate Podcast PDX. Our mission is to give real value to home buyers and sellers, shed light on the home buying and selling process, and give insight about the market and suburbs of Portland, Oregon. I'm your host, Dylan Thomas, licensed principal broker with HomeSmart Realty Group. Although this podcast is centered around home buyers and sellers, Real Talk Real Estate is for anyone looking for home tips and market updates in the Portland metro area. Thanks for tuning in and enjoy the show. Hey, what's up, everybody? Welcome to another episode of the Real Talk Real Estate PDX podcast. Today, I have a good friend of mine and a lender in here. He's been in the real estate business for over 6 years now. First got licensed in 2012 as an agent and then switched to lending about a little over 3 years ago. And I've known him. He actually helped us buy our house 2 houses ago out in Beaverton. So that was 2015.
Yeah, that was a while back.
2015. And that's how I got started in real estate. So it's been a little while. I have Scott Bisson in here. He's with Finance of America, and I'm super excited about today's episode. We're going to be talking about down payment assistance programs, as well as some other specialty programs available to different buyers. Welcome, Scott. Yeah,
appreciate you having me, Dylan.
It's been we were supposed to do this episode a little while ago, and with my own scheduling issues,
We scheduled a couple times.
Yeah, that's my bad. But no, I've been super excited to do this episode with you.
I'm looking forward to it.
We've used the Shanoa program with buyers that we've had together.
Mm-hmm.
And you just rolled a new one out,
Correct.
which is it's a conventional program, right? For
Yeah.
down payment assistance.
Yeah, so it's actually in direct competition with Shanoa.
Okay.
So the Shanoa program, as you know, is an FHA-backed program. And essentially what that program does is it provides clients with their minimum down requirement in an FHA loan, which is 3.5%. So it's given the client their 3.5% for their down payment. And I've had that program for a while now. Have helped, a lot of families get into homes that otherwise wouldn't have been able to.
Sure.
Have, great employment history, great credit. It's just, tough for them to, save up that large chunk for the down payment. So,
especially with their first house. I mean, you're renting.
Oh, sure.
So you're paying money out.
Sure.
And rents are ridiculously high right now.
Yep.
So I get that it's hard to save up for that first house. Once you get rolling, though, I mean, you get the equity built up, you sell, and then you're right into those conventional loans.
Definitely.
So let's start off with the Shanoa program.
Okay.
Like you said, it's FHA backed.
Correct. Yeah. It's it's a relatively easy program to get qualified for. There are no overlays. So basically, what that means is you've got FHA has their general guidelines, right? And then some lenders will have what they call company-wide overlays, right? This has none, meaning that, if you have listeners that are already approved with another lender, they're approved FHA, you can get approved for this program easily. Of course, the only difference there is that there is a one requirement, and that's that you have to be a first-time home buyer. That part can be tricky because, when I say first-time home buyer, a lot of times folks, it might take it as, never owned before.
Right.
In the lending world, what it actually means is, you're technically a first-time home buyer if you haven't owned a home in the last 3 years. So you could still use this program. If you've owned before, you just have to have that 3-year break period.
Oh,
in there.
okay. So.
And so like I was saying, it's a great program, easy to get qualified for. Some of the stipulations is got to have at least a 620 credit score.
Okay.
There is no income cap for this program, which is huge because in down payment assistance programs in the past, they've always had an income cap relative to the median income for a county.
Right.
So in the Tri-County area here in Portland, that's right around about 85,000 and change.
Mm-hmm.
So in years past with other programs, we would try to get folks qualified for these grant programs, and they made a little bit too much, right?
Yeah.
And so we couldn't use them. So that's one of the huge things about this one is, you can make as much as money, make as much as you possibly want, and you can still get qualified for it.
And just could not have owned a home within the last 3 years.
Exactly.
So, I mean, even USDA has income restrictions. So that's a good option for somebody who makes maybe over, even if they're looking to buy rural, if they make over what USDA has the restrictions for, maybe go for this FHA grant program with the Shinola.
100%.
Yeah.
In fact, I have people come to me all the time and they inquire about USDA because that's widely
down,
known
right,
as
right.
zero down program. And I can't think of one instance where I've had a client come to me about USDA and actually use USDA. As you mentioned, there's the rural restrictions, which makes it tough for folks. And then a lot of times it's like trying to squeeze a circle into a square hole because they're so strict on their debt to income ratios.
Right.
FHA typically will allow you to go all the way up to 55%. With USDA, you got your front end ratios, your back, but their max is 43 and 41. And,
Then the front end restrictions on that.
Exactly.
Yeah.
And that 9% might not sound like a lot, right, to a first time home buyer. But that could be the difference between you getting approved for a $200,000 home and a $325,000 home.
Right.
So this program, it definitely trumps USDA.
So let me ask you this. So it's a FHA loan, and then this program is coming in, basically making your down payment for you, right?
Correct. Providing the down payment for you.
So you need a 620 minimum credit score.
Mm-hmm.
What is the debt to income ratios? Are those the same?
They are. Yeah.
So it doesn't get any stricter on that.
Well, I should correct myself there. So as of last week, they switched up the guidelines.
Okay.
It used to be, regardless of your credit score, you'd have a 620, 750. We could go up to a 55% debt ratio.
Okay.
As of, like I said, just last week, now it's credit determined. So folks anywhere from 620 to a 659 credit score, we can only go up to 50%. If you've got that 660 and above, then we can go all the way up to 55%.
Gotcha. So that's still really good then.
Exactly. Yeah. The other thing that I want to talk about too is that I mentioned that there's no income cap for this program, which is true. However, it's basically like two programs in one, right? So if you make under that 85,000 and change, right? This is the great part. The grant is forgivable. Okay. So basically the grant acts as a silent second attached to your first main mortgage. Okay. And after 3 years of payments, that grant money that they gifted you falls off. It's forgiven. The good news is that if you make over the 85K, you can still get qualified for the grant, but you have to make small payments on it. And when I say small payments, let's take a $350,000 purchase amount, right?
Yeah.
It's amortized at 0% over 30 years. So you're only looking at about an additional $55 on top of what your normal mortgage payment would be to qualify for that grant.
Gotcha.
If you make over the 85K.
Okay. So, and that's just for the additional amount that they're granting for this down payment. Now, so if you make under the 85K after 36 payments made, that grant is forgiven, that silent second goes away.
Falls off.
If you make over that amount, you're going to have to pay a small additional towards that. Does it still go away after the 3 years?
No, it does not.
Okay. So it'll just be that extra, say on a $350,000 purchase, it'll just be that extra $55 a month for the remainder.
Correct.
Okay.
Correct. And,
but that's still getting your full down payment.
Front, so. Yeah. You're still getting your down payment covered. So it's a great deal. And to be completely honest with you, most Americans, end up moving every about 6 years or so anyways. And so what I've seen in the instances where they do have that additional payment, we're refinancing them at, the 1 to 2 year mark. And typically by that time, about the 2 to 3 year mark,
market's slowing down.
If the market can keep up at its current pace, right? Let's hope. Usually you'll have enough money, enough equity, I should say, in the home to where we can just refinance you.
Yeah,
and the equity that you've gained will basically cross out that 3.5% gift.
Gotcha.
So it is, it is a short-term loan. Like I said, this is a great program. To be completely candid with you, the one downside is that it is a higher interest rate loan.
I was going to ask. So all this benefit has to come at some sort of cost.
Exactly. So, today's rates on a typical FHA mortgage, somebody with, good credit, rates are sitting anywhere between 3.5 to, 3.75.
Wow.
And with this program, it's a fixed interest rate of 5.125%.
Okay.
So you're looking at about, 1.25 or so higher interest rate than what you would normally get. So that's the only downside. That's the trade-off.
Okay. So basically FHA guidelines, some minute differences depending on credit score. You get your down payment granted to you in a silent second. It goes away after 3 years if you're below the income level. If you're above, you're going to have to make small payments on that until you either refinance or sell.
Correct.
And then a higher interest rate. But that allows you to buy in city instead of having to rely on that USDA with the stricter guidelines and having to go rural. So it makes a whole lot of sense because especially in city, houses appreciate at a faster rate typically.
Oh, certainly. And not to mention that USDA's income restrictions are much tighter than FHA is. And USDA does something what's called household income.
Right.
So regardless of whether or not, you're on the loan, it could be your 16-year-old son that's living with you and he's working, they have to count all income made in the household.
Gotcha.
So what you find a lot of times with USDA is that you can't get qualified for it because you've got too much money in the
income.
household. With this program, it is just based on the borrowers that are on the application.
Gotcha.
So what I've done even in the past where, we had a husband and a wife, one of them made the bulk of the income. And so we just took the other one off to get below that income cap, right?
Oh,
to
sure,
make it
yeah.
forgivable. And that ended up working out perfectly, which of course
then
with
they
USDA,
can still buy the house.
Yeah, that
grant's
wouldn't have been an option. And if you think about it too,
they can still be added to title. So there's
right. Yep.
So, after close, right?
Yeah. So well, no, they can be put on title at close.
Okay.
So husband and wife still both have technically they both still have ownership, right? It's just one of them's on the mortgage to has kind of a workaround there.
Okay.
And the other benefit, if you think about it, when you're doing a USDA loan, that is a zero down program. So you're walking into that home with zero equity. Whereas with this program, you're at least walking in. You're at least walking in with some equity, right? That 3.5%.
Yeah, that makes sense.
Yeah, definitely.
Cool. So that pretty much sums up the Shinoa as far as I can think. Anything else you want to add on to that?
No. I mean, like I said, I think despite the higher rate, if you can stomach that and take the higher monthly payments for a little bit before you refinance, it's a great solid program.
Yeah.
Yeah, definitely recommend it.
I'm really excited about this next one. I haven't got to hear too much about it.
Yep.
I know you guys just rolled it out, a week and a half, 2 weeks ago, something like that?
Yes. Yeah.
This is a conventional down payment assistance program.
Correct.
Take it away.
Yeah. So
does this have a name?
It's called we're calling it the Affordable Conforming Loan.
Okay.
And so I was really excited about this when I first heard about it. Essentially, they're trying to compete with some of the other FHA grants, Shinoa in particular, right? So big difference here is that total different set of guidelines because it's a conventional loan as opposed to an FHA loan. And basically how this one works is that they will gift you a 4% down payment, okay? It works in conjunction with Fannie Mae's Home Ready program, which is a 3% down conventional program.
Okay.
But this grant will gift you 4%. So you've got a couple of options there. You can either use the full 4% towards the down payment, get a little more equity in there, or you can put the minimum down at 3%, and then you have that 1% left over to help with your closing costs, right?
Okay.
Which can be huge. The other big thing, and really the main reason that I was so excited about this program was for the fact that there's no mortgage insurance involved. So on a $350,000 purchase, you're spending about $250 a month on mortgage insurance. So if that goes away, that's a pretty significant drop, right, in your monthly payment.
Oh yeah, totally.
So
I'm still paying about $200 a month on my private mortgage insurance for my 10% down conventional.
Right,
so.
right. Maybe we should look into a refinance.
Yeah. Soon.
Yeah. No, so so I've got a couple of clients that I'm already working with on that one. And I'm pretty excited about it. There's been instances where, with the Shinoa, we weren't able to get one client approved.
Sure.
And this program came along, and because there's no mortgage insurance involved, that dropped their debt to income ratio down enough to where I was able to get them approved, and they're out shopping right now. So you take that mortgage insurance off, which is roughly $250 a month. So that allows you more buying power. Exactly.
Okay.
Exactly.
So with this, so you get the 4% down. It's a conventional 3% down loan. So you get 4% total. What are the, there's no income restrictions, is there?
So there is an income restriction on
Okay.
this one, but I think it's quite generous. It's $123,000 per year.
Okay. So you can make up to
$123,400 per year to be exact.
And not household, just
exactly
whoever's on the loan, correct?
Yep, whichever borrowers are on the loan.
What is the credit score requirements?
Credit requirements for that one's 660.
Okay.
So
you need to have at
higher.
least 660.
Yep. And if you've got somebody that's right around there, I do offer credit repair as a free service to my clients. So, to those that are interested in these grant programs, but they feel that their credit's, not quite to the 620 or 660 that you need, still highly encourage anybody to, reach out, we'll fill out an application, figure out exactly where you're at. And you may even be there. I find that most consumers use Credit Karma to monitor their credit. Right. Credit Karma is great to alert you to missed payments or new accounts that have been opened, right? Fraud stuff. But when it comes to actually determining the credit scores themselves, they're not all that accurate. I'd say they're accurate to within about 40 or 50 points. So
it's a good guideline. But it's not indicative of what your actual score is.
Correct.
I mean, I always monitor on Credit Karma just because I like to watch and see what's going on. But there have been times where I've applied for loans and it's either higher or
exactly.
I don't think I've ever applied and it's lower, but usually it's higher.
Yeah,
I feel.
Yeah. So that's the other thing. So don't let the Credit Karma discourage you too much. It's really easy, takes less than 15 minutes to fill out an application and pull credit. And like I said, if you're not quite there, usually there's a way that, I can help the client build their credit up to get them to where we need to be.
Yeah, get up to that 660.
Yeah.
So is this a grant program or is this also a silent second?
So it is a silent second as well.
Does it go away?
This one does not. No.
Okay.
So regardless of income, this one does not go away. It is, it's amortized, same as the first mortgage, right? So 30 years. And the interest rate on the grant or the second is identical to the interest rate on the first. So I'm saying that, let's see, what did I run the other day? I think this was a 360 purchase, and it was an extra $55 or $56 a month that they're paying.
Much better than the private mortgage insurance that you're going to have on an FHA loan.
Exactly.
So, I mean, you're saving $200 there.
Exactly. And the other nice thing too is that, again, where the Shinoa, the FHA product, is a fixed interest rate at 5 1/8, this program is not. So you do have some flexibility with the rate as well, whether or not you want to buy the rate down further. Let's say maybe somebody's short on closing costs, right? At that point, we can bump up the rate to get them a rebate to help cover those, the missing closing costs. So that's another positive feature about this one.
That's awesome.
Yeah.
That's really cool.
Yeah.
So you get your 4% down payment assistance. You need to have a 660, no income limits.
Well, their income limits on the conventional.
Oh, that's right.
Up to 124,000.
124. What are we missing here? Oh, interest rates. What are rates like? Are they in line with conventional rates?
Not at all. No. So again, it's a double-edged sword. Just like the Shinoa program. These guys, they've got to recoup that grant money, and some ways part of it is that extra little payment they're going to have.
Right.
But rates for this program are going to be closer to what Shinoa was, right around 5%.
Okay.
And again, this is heavily determined by credit score,
Sure.
right? So somebody that has excellent credit,
But they're not fixed, so they're not at the 5, 1, 2,
exactly.
5. So
you can choose.
yeah, so if you have better credit, this is the rate's going to go down, right?
Correct. Yeah.
Okay.
Yeah, you could be closer to 4 and 4 3/4, as opposed to the
Which
5.
is still a really, really. I think we're sitting at right around there. I mean,
Right.
I think we're at 4.625 when we bought 2 years ago.
Yeah.
So,
yeah. I mean, it's not to mention the fact that
and we didn't get down payment.
Right.
We didn't get the additional
you're
benefit
getting,
of that.
You're getting 4%. I mean, you're getting your entire down payment covered. I've even done it. We've set a couple of these up to where folks they really hadn't saved much.
Right.
And so if these programs were able to not only get your down payment covered, but the other largest cost involved when you're purchasing a home, obviously, is closing costs, right?
Right.
We even have a workaround for that, and sometimes
that's amazing because sometimes, especially, so you're using down payment assistance because you don't have the down payment funds,
right?
And then you're heading into make an offer. Maybe there's multiple offers, and you're having to ask the seller to pay additional concessions and seller credit towards buyer's closing costs.
Exactly.
It's not always going to work out.
Exactly.
In a perfect world, it would always work out, but it doesn't always, because then you run into issues with possible appraisal issues, so on and so forth. So that's amazing that this program has that workaround where you can buy the rate up a little bit to provide an additional buffer towards those closing costs.
Exactly. Yeah, exactly. So
that's going to be huge.
Yeah.
I mean, I don't see any reason, unless you're below a 660 and must absolutely buy a house, any reason why somebody wouldn't at least explore this option.
Definitely worth exploring. Yeah. I mean, regardless of where you're at. But yeah, back to the closing cost piece. Typically we see closing costs at about 3% of the purchase price, right? Just to give a general estimate. And so, you've got your down payment covered with this program. We can either have a seller cover your closing costs for you, or we can wrap it into the loan. And basically what that means is, let's take again $350,000 purchase. Let's say you've got $10,000 in closing costs. We just up your purchase price to $360 from $350 and get that $10,000 credit from the sellers. That way you've got the two biggest costs associated with buying a home covered, right? The other cost when you buy a home, the main ones, is your earnest money, of course. Typically, you're looking at about 1% as rule of thumb for earnest money, but really nobody does that. You could do $1,000, you could do $2,000 for earnest money. Only other cost you've got are your home inspections, which is around $500-$700 today.
Yep.
So if you think about it, and this is really pretty amazing, but if you go with $1,000 earnest money, I mean, I got a family just last month into a home, and all they had was $1,700 out of pocket
Yeah.
because
Yeah.
we got their down payment covered, their closing costs covered. All they had to pull in was their earnest money and their home inspections.
Yeah, and I've had certain scenarios where if you get enough of those credits back, the buyer's actually getting a
Get
check back
money back at close.
So
Yeah.
they'll be getting that earnest money back or a portion of it.
I think we actually had a
Yep.
deal together that when that happened, we were able to get all of his $2,000 earnest money back because of that seller credit. Yeah.
So
Pretty pretty smoking deal, you know?
yeah, so those are huge.
Yeah.
Either way to go. How can people reach out to you to start this process if they choose to?
Yeah, so I'm on social media. So Scott Bisson. So if you go on and you Google Scott Bisson Mortgages, you can go to our company website, which is financeofamerica.com. You can look me up there. You can look me up on Facebook at Scott Bisson Home Loans. Or you can.
What's your email?
Email? Yeah, so email scott.bisson. SCOTT.B as in boy, ISSON at financeofamerica.com.
Awesome.
And then if you want to, if you're more of a texter or, would like to, you got a couple questions I'd like to call me, you can always reach me directly at 503-860-2477.
Yeah, I just think those are huge. And anybody who's in Oregon, where else are you licensed?
Oregon and Washington.
Oregon, Washington.
Yeah.
So anybody who's in Oregon, Washington can reach out to you and start the application process. So beyond the down payment assistance programs, what kind of other specialty loans do you guys have in-house? I know you and I specifically were working with a client who was looking at utilizing a bridge loan. She did not
Correct.
end up going that route, but maybe eventually once she decides to go forward. So you guys have the bridge loan. Can you tell me a little bit about that?
Yeah. So, bridge loans used to be huge back in the day, and I feel like they're making, a little bit of a comeback in this market. Bridge loans are really complicated loan. Depends on, how much equity you have in the home that you're selling.
What exactly is a bridge loan?
So a bridge loan, basically what that allows you to do is say you've got your home up for sale or thinking about selling it, and you've already found the home that you want to purchase, right? You've got a timeline there. Bridge loan will allow you to immediately take the equity out of the home that you currently own and use that to put towards the purchase. Okay.
Yeah.
And then once you've closed and once it's sold, you basically get the rest of the equity left over.
Yeah.
So essentially, it's a way to transfer equity from property to property, but you don't have to wait
without
for the
going
first
through
one to
the
sell.
closing process, right?
Exactly.
So the super handy tool if your house is on the market or you're getting close to putting your house on the market and you already identified the property that you're going to purchase. Super handy, especially in these times where days on market is increasing and the market's slowing down a little bit. I think you're going to be utilizing that a lot more.
Yeah.
And that's at conforming rates, correct?
Interest rates a little bit higher on the bridge loan,
But not by much. When we were looking at it, it wasn't much.
Yeah. It's I think it was maybe about a half a point higher.
Yeah.
But keep in mind that that's a temporary rate, right?
Right. Refi.
And then we actually do the closing on the purchase, and you'd be at so you'd be subject to typical rates then. But, and there's certain circumstances
too deep into the bridge loans.
Yeah.
Because I really wanted this episode to be focused around those down payment assistance programs, which I think so many people can utilize without having to go rule and go through USDA guidelines. But the bridge loan, how long do you have to wait to make your first payment on that? Is that the 30-day close, same as your normal closings? Like you got to wait the full month?
No. So the way that it works is you actually don't have to make a payment until you close on the purchase.
Yeah, that's amazing.
Yeah.
So you're able to sell your house, buy your house without selling your house.
Exactly.
That's pretty cool.
Yeah, and really the only main stipulation on that one is that before you can get qualified, you just have to have the property on the market. That's it. You don't have to be contingent or in escrow or anything. It's just got to be just be listed. And
day one, they can reach out to you and get applied for this
and look into it and see if it's a good fit.
Start closing on the next one, so they could actually they can move out of their house that they're selling
right before ever
closing.
And here's another thing to consider too, just because I know these days I keep hearing more and more about open house, which, as you know,
Open Door,
Open Door, right? Which is a company that they're offering to flat out, buy your house cash. On face value, it sounds really nice, right?
Right.
I've actually had 2 clients just within the last 2 weeks that they were pretty certain that was the route that they were going to take, right? Just because they had already found the house they wanted to buy. Yeah. Neither of them ended up going with Open Door because it's such an expensive service. So anybody that's looking at Open Door, I think you might find that this bridge loan option is going to be a much less expensive option for them.
Yeah.
Yeah.
Oh, by far.
Yeah.
I'm going to do a whole episode on
Open
Door and Zillow. The iBuyers are.
It's like, both of these clients, they were pretty gung ho, and they needed to sell pretty quick because we were already in contract.
Sure.
And we were bumpable.
They sell
status,
that convenience.
So, they saw the convenience,
very high price,
and then they saw the fees, and they instantly ended up going the traditional route.
Cool. So the bridge loan's working out good there.
Yeah.
Any other specialty programs that you have in house?
Yeah. So. Actually, so one that just came down the pipeline, it's not live yet, so I don't have a lot of info on it.
Okay.
But we're introducing a one-time construction loan.
Okay.
So this is going to be huge, I think, because traditionally, when you go to purchase land and build your home, you've got to first go get the land loan, right? Which requires, quite a bit of capital up front there. Then
usually like 20% down, right?
Yeah.
For land.
Yep.
20 to 30.
20.
From what I've heard.
Yep. 20 is going to be the absolute, minimal for the land. Then you got to work on the construction loan. Then you got to, sometimes you'll have to convert that land loan into a final construction product, or you might, have 2 closings there, right? One in the land, one in the construction.
Almost always.
And so what this program allows you to do is, and it's the same.
Plus extra cash for permits along the way.
Exactly. And so this program will basically allow you to buy the land and fund all the construction costs at once. So just one close. Essentially, you're going to be saving a ton of money on closing costs because you're not having to close on multiple loans, right? It's just one.
That's amazing.
And from what I've heard, it's going to be, and don't quote me on this, this is just rumblings that I've heard, but that it's going to be a 5% down program, which is huge.
Wow!
Because,
I wish you guys could have seen my face because that just shocked me.
Usually when you go to buy a house, it is very capital intensive, right? You've got to have a lot of liquid assets available. So if this rolls out and it is a 5% down, one-time construction close, I think it's going to be a game changer. So I'll keep you updated on that one as soon, once it goes live and I've got a little more information on it. But
please do.
That one.
I'm already thinking of people who could utilize that right now because, I have so many people come to me. Yeah, I have so many people come to me who say, "I want to buy land and I want to build a house," and I love that, but at the same time, I know the steps and I know how expensive it is to do that, and usually you're not better off financially to do that in most scenarios,
right?
Especially if you're doing a stick build,
right?
So you have to buy the land, so you got to have that capital to buy the land, and then you got to apply for a construction loan, which. You're going to have to do the permitting process. Most construction loans don't include the permitting, so you're going to do that.
That's usually out of pocket, yeah.
Yep. So you have a whole lot of out of pocket, and sometimes when people are thinking these, it's rural, so you're going to have to pay for the septic, you're going to have to pay for the well, utilities. You're talking hundreds of thousands just to start building.
Right.
And then you're still going to have to close on your construction loan at the end. Sure, you can recoup some of those costs and wrap it all up into one. So when Scott says 5% down to fund the land purchase and construction, that's just, I'm shaking my head no because I'm in disbelief.
Yeah, yeah. Like I said, again, just that's what I've heard. Nothing's set in stone yet, but
can't wait to hear more about it.
If that is what it ends up being, I think it'll be a game changer.
Yeah.
Yeah. Let's see here. While we're on the subject of new construction, which is pretty close to remodeling, especially in this market with the way housing prices are, you see a lot of properties that are, maybe it's a foreclosure, it's just a property that there's so much wrong with it that it does not qualify for financing.
Mm-hmm.
I also do renovation loans, or it's a 203K loan. So it also is an FHA product, so 3.5% down. And what this enables the borrower to do is essentially go and purchase this home. It doesn't have to be a fixer-upper either, right? You could buy a home, but maybe you just don't like the kitchen or a couple of bathrooms, right?
Do some remodeling, sure.
Exactly. So this program allows you to go out there and hire your own general contractor. You can go through the house and decide what work you want done on it. And they will actually give you the funds, not only to purchase the house, but then after you close, they'll give you a couple of disbursements for that contractor to go back out there and complete the work within 6 months. So there's really no limit on how much repairs you can do either. Of course, you have the FHA county loan limit, which is $474,000. So as long as your purchase and your repairs are staying under that amount, that's another great program that I don't think a lot of people know about, and it's definitely more of an undertaking than your more traditional purchase, right?
They're a bit more work, right?
Because you've got to go out, you've got to find a licensed contractor, you got to get all the quotes done for the work ahead of time. There's multiple appraisals that have to happen
before closing. All this has to happen before closing.
Exactly. Yeah. But then once you're closed,
so it's just upfront challenges, which are really not that big of an issue.
It's really
easy to work through.
And typically people that are going to remodel a kitchen or put new windows in or siding, normally they're those are the type of people that they're not going to have an issue with those couple extra steps,
right?
So I think the 203K, the renovation loan, again, is a great product that I don't think it is taken advantage of enough.
Yeah. I think I have to agree.
Yeah.
I think I've done one.
Right.
But there are some upfront work, but that's what I'm here for, right?
Yep.
That's what you're here for.
And myself.
To get them through that and to help it work towards a smooth close.
Yeah, definitely.
So I'm really excited for that new construction loan. I can't wait to hear more about that. The bridge loan is great. I'm glad to see those coming back.
Yeah.
But the first-time home buyers, those down payment assistance programs, I mean, that's huge. That's one of the biggest misconceptions I run across is, people saving up for that 20% down.
Mm-hmm.
Not needed. You don't need any down, really.
Right.
You need to have a little bit in the bank for inspections and earnest money, but
other
than that, we can take care of all that for you.
Exactly. Yeah. So, no, great programs there. Another piece that I was going to touch on a little bit, and switch gears here. We call it Finance of America. It's our commercial division. Basically that's where we work with builders.
Gotcha.
And you don't have to be a builder. You could be somebody that, all of a sudden has said, hey, I want to build a house and sell it. So all of these programs that I'm talking about are non-occupant borrower programs, right?
Gotcha. Okay.
So we've got, new construction loans for investors. So if you got investors or builders out there that are looking for capital right now, got a couple of programs
Need to go buy a lot, build a house and sell it.
Exactly. Yeah.
Or build multifamily.
Right. Yep. And we can go up to 4 units.
Okay.
And then, so really this division is split into two. You've got the new construction side, and then we also have something that we call a renter's loan. And so that will allow you, again, experience or no experience, but you want to acquire a couple of condos, right? Or even a single family home to rent out. This program will allow you as an investor to purchase that asset and then start renting it out. And it's got to fit into certain parameters. But essentially, your net income that you're making each month from those rentals are at least in the instances I've seen, almost paying for the loan itself. So that's something else to look into.
That's amazing. I think, I know we're kind of running out of time for today's episode, but I think we should get you back here to just talk in depth about different ways to invest, because I think there's a huge need for people to invest in real estate. I think real estate's one of the best investments you can make across the board, better than...
I agree.
I'm going to say better than IRAs and 401ks.
Right.
But I'm a little biased. I'm in the industry and I know it in and out. So I think that's something we could really dive into. Yeah,
no, definitely. I would love to. Like I said, those programs are a lot more complex, than your standard just residential purchase. But next time you have me on, I'd love to dive into them a little bit more.
That'd be awesome.
Yeah.
Quick recap, couple down payment assistance programs, went over a little bit of the bridge loan, and I'm super excited to hear about the new construction loan. Of course, your renovation loans, which, oh gosh, that's another one we should do. Just the in and out of the renovation loans, because they are pretty in depth and intense. And, as far as the limits that you can have to remodel and do all that kind of stuff, and what the house originally has to qualify for too as well. We could do a whole episode on that.
Oh yeah. So I've had with the renovation loans, I've had numerous borrowers in the past that fell in love with this foreclosure. They've they're looking for a fixer. They're wanting to flip it.
Everybody wants to flip.
And, unfortunately, most of those are cash only, right?
Right.
But you don't have the full cash. You can do the renovation loan, the 203K, and get into it that way.
Yeah.
So it really opens up, numerous avenues.
Yeah. A lot of options to explore.
Yeah. Yeah.
Awesome. Well, thanks for going over those with us, Scott. I really appreciate you coming on and taking the time out of your day to do this.
Yeah, I appreciate you having me, man. Yeah, it's my pleasure.
I hope the listeners got a lot of value out of this. I think more than anything, it's just eye-opening to see all the different options in lending, instead of just thinking you need that 5 or 20 or 10% down, and that's it. That's your...
You'd be totally surprised. There's this, there's still this conception out there that, and a lot of consumers, believe this, that, in order to purchase a home, you need 20% down.
Oh yeah.
And, that's just not the case anymore.
Right.
We've got programs, they're conventional as little as 3% down. And then again, we've got those grant programs that are, basically covering your down for you. So, it's, definitely worth looking into, if you're on the verge of buying or, maybe in the researching phases, reach out, and I'd be happy to, answer any questions you might have.
Yeah. Or even the credit repair,
exactly.
Just getting you in the right position to make a purchase.
Yep. No, yeah. Certainly.
Cool. Thanks again, Scott.
Hey, thanks, Dylan. I appreciate you having me. Bye.
Thank you for tuning in to the Real Talk Real Estate PDX podcast. Stay up to date on Portland real estate action by subscribing or follow along on Instagram at Real Talk Real Estate PDX. Any questions or comments about this episode or any real estate matter, feel free to reach me at dylan.pdxrealtor@gmail.com. Thanks again and have a great day.